In the world of finance, things can change in the blink of an eye. Just a few days ago, the troubles of Silvergate Capital, a California-based bank, jumped on the crypto bandwagon. Unfortunately, things have taken a turn for the worse for Silvergate, as the bank recently announced that it plans to wind down operations and liquidate the entire bank. Silvergate's troubles stem from massive write-downs on bad investments, including securities, derivatives, and intangibles. The bank's balance sheet has been hit hard, with total assets falling from $15.4 billion to $11.3 billion. To make matters worse, the spread between their total liabilities and assets fell to less than $600 million, down from double that amount. As a result, the bank is now liquidating its assets to repay its deposits. Don't forget to subscribe to our channel and hit the notification bell to watch our latest videos as soon as they are released. The news of Silvergate's bankruptcy has sent shockwaves throughout the financial world, particularly among those in the crypto community. Silvergate was seen as a major player in the crypto space, providing on and off ramps for individuals looking to convert dollars into crypto and vice versa. With Silvergate gone, the crypto industry will need to find a new intermediary to bridge the gap between fiat and digital currencies. In other news, Coinbase, one of the largest cryptocurrency exchanges, has recently come under scrutiny for the potential theft of funds. While the details are still emerging, it's clear that someone at Coinbase was involved in some suspicious activity, prompting a warning sign for those who use the platform. The world of crypto is under more pressure than ever before, with increasing scrutiny from regulatory bodies like the SEC and FDIC. Comment crypto if you would like us to make more videos like this in the future. The demise of Silvergate is a clear indication that the crypto industry is facing some hard truths. If banks can't fulfill their deposit requirements, it's ultimately up to the FDIC and potentially the government to bail them out. This puts more pressure on regulators to take action, but it's not the kind of regulation that's going to be easy to swallow. Despite all of this, there is still hope for the future of crypto. Many are paying close attention to the Grayscale Bitcoin Trust, which is on track to become an ETF. Unlike mutual funds or other investment vehicles, ETFs don't suffer from the same problems of dilution, discount, or premium. They simply represent how much money is invested in them. This means that ETFs are much more preferred, and there's a high likelihood that we will end up with cleaner regulation as a result. The road ahead won't be easy, but it's important to stay hopeful. Remember to give this video a thumbs up if you've watched it all the way through now, as it inspires us to create more engaging content just like this. There is still a lot of excess to be flushed out of the crypto industry, and it's likely that we'll see more ups and downs in the coming years. But if we can weather the storm, there's a good chance that we'll end up with a more stable and reliable system. So let's keep our eyes on the Grayscale Bitcoin Trust and see where this road takes us. Bitcoin has been making headlines in recent years, with its meteoric rise and fall attracting the attention of investors and regulators alike. One way that investors can gain exposure to Bitcoin is through the Grayscale Bitcoin Trust, which manages a pool of Bitcoin on behalf of investors. However, the trust currently trades at a discount to its assets due to regulatory risk and illiquidity. To address this, Grayscale is suing the SEC to turn the trust into an exchange-traded fund ETF, which would provide a safer and more convenient way for investors to gain exposure to Bitcoin. This move could also help to reduce the risks associated with storing Bitcoin on exchanges or in cold storage. In fact, some investors see a Bitcoin ETF as the easiest way to gain exposure to the crypto market. However, the SEC has rejected multiple applications for a Bitcoin ETF, citing concerns about market manipulation and investor protection. Meanwhile, conversations around Bitcoin and the government continue to evolve. Even staunch Bitcoin critic Peter Schiff and his son, a Bitcoin enthusiast, can agree on the idea that a smaller government is better. The potential for blockchain-based arbitration of disputes is also a topic of discussion, though the question of how to enforce the outcomes of such arbitration remains. Jared Ferguson is reportedly suing Coinbase for over $96,000 in lawsuits losses due to being a victim of SIM swapping. This type of fraud occurs when someone impersonates the victim and requests a new SIM card from their phone provider, allowing them to access the victim's phone number and potentially reset passwords for online accounts. In this case, the fraudster allegedly gained access to Ferguson's Coinbase account and transferred funds out. Ferguson is claiming that Coinbase violated the Electronic Funds Transfer Act and Article 4A of the California Uniform Commercial Code, which protects customers from electronic fund transfer fraud and unauthorized transactions. However, it's uncertain if he will win the case, as Coinbase is not a bank and is not subject to the same regulations as banks. The incident highlights the importance of security measures for online accounts, especially for cryptocurrency exchanges. Two-factor authentication, including using authenticator apps and setting up additional security measures with phone providers, can help prevent SIM swapping. Additionally, some experts recommend holding cryptocurrency in cold storage, which involves storing the coins offline rather than on an exchange. While the SIMs may seem more secure than physical SIM cards, they are not immune to SIM swapping attacks. Therefore, it's essential to take all necessary precautions to protect online accounts, especially those containing cryptocurrency. The incident with Ferguson serves as a reminder to remain vigilant about online security and to take steps to protect personal information and assets. The analogy drawn here between guns and crypto storage is an interesting one. While it is possible to hide multiple guns in different locations to ensure their safety and security, it can be a challenging and time-consuming task. Similarly, in the world of cryptocurrency, it's possible to store your coins in various wallets, but it requires a lot of effort to keep track of them all. Like guns, cryptocurrencies are valuable assets that require proper storage and protection. If you have multiple wallets, you need to ensure that they are all secured with strong passwords and backup phrases, and you need to keep track of where you've stored each wallet. While storing your cryptocurrency in multiple wallets can provide added security, it can also be a hassle. Not only do you have to keep track of where each wallet is located, but you also need to ensure that you have access to each wallet in case you need to make a transaction. Overall, it's important to strike a balance between security and convenience when it comes to storing your cryptocurrency. While you want to ensure that your coins are safe and secure, you also don't want to make it too difficult to access them when you need to. It's up to each individual to determine the best way to store their cryptocurrency based on their personal preferences and risk tolerance.